The stock market's hit a high watermark, 15,000. But what does that actually mean to you as an investor? Well, today we're joined by Dylan Bond. He's the owner of Bond Financial Services, and he's here to share tips on planning your retirement. Thank you so much, Dylan, for joining us.
It's great to be here.
So that number, 15,000, what does it actually mean?
Well, it actually means nothing. The market is where it is. What it means to me when I'm talking with people about their finances is that the market has recovered from the losses that it endured in 2008. Took a long time to get back, but now for the first time, a lot of people are noticing that their accounts are in the black. They're back above where they were in 2007. So I think what it really means is it's a good time to take a look at what you're doing. And look at what other options might be out there so you don't get yourself put back in that same type of situation.
So in other words, if in 2007 you invested $100, that money is back up to $100 now?
Well, it might be. I mean, it depends on where you invested it, but if you're talking about the averages out there, yeah, the market's a little bit higher than it was in 2007. Now, it depends on what type of accounts you owned, how many fees and expenses were being taken out along the way. All those things matter. So there are probably some people out there that owned higher expensed accounts that might be still getting back to break even rather than being a little bit above it.
But that's what the Dow Jones is anyways. It's just an average of a lot of big stocks.
That's right.
Now, it's a great time to reevaluate because we've kind of hit a great peak, but it's always a good time to reevaluate. You always need to keep thinking about your money.
Yeah, I've been doing this now for almost 20 years, and what I find is people seek advice when the markets are doing very poorly. When I think that's the worst time to make any changes. You really don't want to take a loss. Well, like in 2008, if the market was down almost 37%, if you were to get out then, you would have missed all of this comeback, and you would have had a lot less money today than if you stayed in the market, endured, and let that money come back.
And this is like the worst time, to talk about reinvesting, because normally when it's down, that's the time you want to stick with it.
And again, it depends on who you are. It depends on your risk tolerance, how old you are. I always talk about the stock market. I work with people 50 and older for the most part. And I use the analogy, it's like Riverside amusement park. Back when I was younger, I could go on the loop coaster 10 times in a row and I never had a problem with it. But now that I'm getting older, it seems a little faster and a little higher every time I get on a different roller coaster ride over there.
Just standing in line makes you sick.
Exactly. So the market's always going to have volatility. It's just that as we get older and we're going to need our money sooner, the volatility affects us more. So you really have to start looking at different ways of positioning your money. If you're going to be invested in the market, you have choices. You could use passive stock mutual funds that ride the market trends up and down. You can use what are called actively managed accounts, where you'll have professional money managers managing that money, trying to avoid the risk and take advantage of the potential returns. And by doing that, you might be able to eliminate some of that volatility. So over the long term, you won't have those real big swings in the values of your accounts.
Well, and there's so many ways that you can manage your money. Tell us about active management versus passive management.
Yeah, well, in the most general terms, if you were to buy an S&P 500 mutual fund, and let your money sit in that for 10 years, you're going to find that it's going to ride the market trends of the S&P 500 very closely. So in 2008, when the market was down 37%, you probably would have been down about that if you were in an S&P 500 mutual fund. Whereas there were some active managers out there that in 2008 lost less than 5% because they actively managed the money out of the way of the risk. And put it on the sidelines so that when the markets went down, they weren't in with it. When the markets started coming back up, they started to move back in slowly, and they captured a lot of the upside from the recovery. So in that position, you can find that you had less volatility and your values of your accounts stayed more true to your overall objectives.
And that's why someone should come to a place like Bond Financial Services, because you take an active role in their finances. You just don't put everything in there and just let it sit by the sidelines.
Yeah, in this day and age, I work with a lot of people. They come in and they flat out tell me, they say, Dylan, we've been through the ringer a few times. It always sounds good when we're talking about things. One thing I try to do is never oversell and underdeliver. I'd rather undersell and overdeliver. But basically, the key is understanding what you're doing and why you're doing it. And I take as much time as I need to with whoever I'm working with to sit down and make sure they understand everything we're talking about and why we're doing it. It might take 3 or 4 meetings. Sometimes it takes 4 or 5 meetings. But my objective is, before we become partners in a long-term relationship, I want to make sure we establish the right terms and parameters of our relationship going forward before we jump into anything. Because if we have surprises along the way, it's going to make my life more difficult as well as theirs, and I don't want that.
Now, Dylan, if people want to get to know you more than they already do, because you're here every week, do you have an upcoming golf seminar where you're going to talk to us about your financial view, and everyone can have some fun playing golf?
Next Wednesday, the 15th, we're going to do a golf seminar at Twin Hills Country Club. It's going to start at about 8:30 in the morning. It's by reservation only, so you have to call the office, talk to George. If you're 50 and older and you want to put a foursome together of friends just like you, give George a call. We'll serve breakfast at 8:30. I'll talk at 9, and we'll be out on the course by 10 o'clock.
Not a bad day.
It'll be a good time, yeah.
Dylan, it's a pleasure having you here as always. And you can visit bondfinancialservices.net or call 413-754-4747 and just let Dylan and his staff take the steps to secure your financial future.